Hello friends, Chris Lee, CPA here, and I work with growth-minded entrepreneurs to help them achieve smarter, more tax-efficient growth. And today we are going to talk about cost segregation studies. So if you're at all in the Google sphere of like looking at tax planning strategies, and so often you'll see the big benefits touted of real estate and how it gives you depreciation deductions. And in the post One Big Beautiful Bill era, we're seeing so much conversation around bonus depreciation and how much benefit that gives you when it comes to real estate investing and real estate activities. And so often this requires what's referred to as a cost segregation study. So today we're going to talk about, what is a cost segregation study? What are the benefits, when to do it, when not to do it, kind of the pitfalls and all those sorts of things. So to lay the groundwork, when it comes to cost segregation studies, what we're really trying to do is optimize the depreciation deductions that occur when we are, pursuing a real estate activity as a tax planning strategy. So typically when we buy an asset, a real estate asset, we are taking a property that is going to have, by tax law, a deemed depreciation life of 27 and a half years or 39 years. So what that means is you're going to take the value of the building, not the land, just the building, and you're going to depreciate that largely on a straight line basis across 27 and a half years. What does that mean? Or 39 years, depending on what type of property it is. So what that means is super slow. It's going to take forever to claim all those benefits. So but the good news is we can, do some tax planning and accelerate those deductions. And so when I say accelerate them, rather than claiming those deductions over 27 and a half years, we can get some of those deductions, claimed much faster. And we do that through what is referred to as a cost segregation study. When it comes to when you buy a piece of property, kind of get into the groundwork of what a cost segregation study is. When you buy a piece of real estate, whether that's a residential rental property, a non-residential property, what happens is you're paying one lump sum for an asset that is more than just one asset. You're paying one lump sum for a building, the land that building sits on, so the surrounding land that actually is underneath the building. You're paying for the improvements, that is the landscaping, paved parking areas, the fences, all those sorts of things. So land, building, improvements, and you're also paying for the personal property. And that is to say the refrigerator, stoves, dishwasher, carpeting, hardwood floors, all those sorts of things. So as I said earlier, those items that are categorized as improvements, building, and personal property without any tax planning executed, those are generally going to be depreciated as 27 and a half year assets if it's a residential rental property, or if it's a commercial property, it's going to be depreciated over 39 years. They're both using a straight line depreciation method, which is the slowest depreciation method possible. So when we acquire assets and we're going to claim depreciation on them, legislatively, there are asset classes and depreciation rules that are mandated. And so we can't change those depreciation rules that apply to an asset class. But if we can, get assets to, by definition, be in a different class and therefore have a different set of depreciation rules, that's the goal. That's how we can kind of speed things up. And that's what a cost segregation study does. It takes the assets that are all bundled into this one purchase that is, without any other meaningful tax planning, going to be treated as one asset with one 27 and a half year life, or one asset with 39 year depreciation life. We're going to take those assets, do a study, and say, wait a second, we've got some personal property in here that's not going to last 39 years or 27 and a half years. We've got some improvements in here that's not going to last 27 and a half years or 39 years. And we're going to split those apart. We're going to do the work and we are going to say, no, we've got a cost associated with some of these items that aren't, long-lived assets as, say, the building itself, the whole building infrastructure itself. And that's what a cost segregation study does. It segregates the costs of the real estate that we've purchased into different asset classes. It takes the personal property and the land improvements that have, by legislative, law, that has a much shorter depreciation period than the commercial building or the residential building and those building components. So what that means is you can depreciate them much quicker. Personal property is generally depreciated over 5 or even a 7-year period, and land improvements are typically depreciated over 15 years. So those two categories are so much faster than the residential property, which is 27.5 years, and the commercial property, which is 39 years. So in total, your depreciation deduction won't be different if you were to hold the asset through its entire life, but it does make those deductions move closer in time to when you purchase the asset. And what we know is if deductions taken sooner rather than later have a time value of money benefit. So if you can take deductions on the front end, you pay potentially less tax, and the less tax you pay can generate after-tax cash flow that can be invested in another asset to generate additional cash flow. So that is largely what we're doing. So when we buy an asset, typically 20 to 30%, when we buy a real estate asset, I should say, typically 20 to 30% of the value of the commercial or residential property consists of personal property and land improvements. And so when we combine that with the fact of the post One Big Beautiful Bill era, where we have 100% bonus depreciation, which is to say assets with a life of 20 years or less can have the depreciation of that asset, not just in those initial years, it's spread across the shorter life. It can be taken all in year one. So that life that we've said, personal property is 5 to 7 years and land improvements are 15 years, we can apply the bonus depreciation rules that overrides those rules and say all of it can be claimed in year one. So let's take an example. We've got Alan, who maybe purchases in 2025 a small rental home for $240,000. He determines the value of the land to be, let's say, $40,000, and then he has a building component that is $200,000. So we've taken the $240,000 purchase price and split it between land, which is non-depreciable of $40,000, and the remaining depreciable assets of $200,000. If Alan were to use regular depreciation on this asset, he would depreciate $200,000 across 27.5 years. His annual depreciation deduction will be $6,970 in the first year approximately, and the remaining 27 years would be $7,272 approximately. What Alan might consider doing is using a cost segregation study where he can deduct the cost of the home's personal property and land improvements much more quickly. So let's say he does a cost segregation study through the reasonable means available, and he determines, and it's determined that the home's appliances have a $6,000 cost, right? So of that $200,000 of that purchase price, $6,000 of it goes to appliances, and then we've got $10,000 that goes to flooring, and then we have that property fence, and that was $14,000. So that is $1,000 plus the 10 is $16,000 plus another $14,000 is going to be $30,000. So $30,000 of that 200, right, of building components can actually be attributed to something other than a 27.5-year asset. And so when we've got that $30,000 and we're in a post bonus depreciation year, we can actually claim $30,000 of depreciation in year one. So for those assets, we can, claim those personal property and land improvements as $30,000. And then the remaining $170,000 of depreciable basis for the building components can be depreciated over to the 27.5 years. So we've now got 4 assets we've identified: the appliances, the flooring, the fence, and the building. And all of those items are going to be depreciated in year one. We've got $30,000 from the 3 components that are either personal property or land improvements. And then we've got the $170,000 being depreciated across 27.5 years, which in year one is going to give you approximately $5,900 of depreciation deductions. So the total of the 4 assets with the cost segregation study gives you deductions of $35,000, $36,000 approximately. This is compared to no cost segregation study where he has, about $7,000 of deductions in year one. So that is a huge savings, right? Like that's almost $30,000 of additional deductions. So all of the cost segregation study work is to separate the building and the components and the personal property and land improvements. We want to take those two pieces and separate them. We're segregating the costs of the asset purchased. So to date, the IRS has not established any mandatory requirements or standards for cost segregation studies, but they have issued detailed cost segregation audit guides and to say what is, acceptable and, not acceptable. Now, when it comes to cost segregation studies, there are a few things we have to think about of like when they're appropriate and when they're not. So the first thing is that your accelerated depreciation might be limited due to certain rules, often referred to as the passive activity loss rules under Section 469. So what this does is basically say that it prevents owners of rental real estate from deducting losses in excess of their passive income. So rental real estate is categorically by statute treated as a passive activity. There are a few ways to get out of this. One of them is to be a real estate professional and obtain what's called REP status, real estate professional status. Another thing is to use a short-term rental where the average stay is less than 7 days, or we can use grouping elections, which basically says this rental real estate is actually a meaningful component of a trade or business. And because of this, it really isn't primarily a rental activity. It's related to a trade or business and therefore non-passive. Those are the three ways generally to get out of this. But aside from that, if you're subject to the passive loss rules, we do also have some active participation rules where there are some limitations related to the rental losses, but regardless, we'll just assume that we've got, we've got to always consider the passive loss implications that may occur due to the fact that passive losses apply in general. It's the default treatment of rental real estate. So we first have to come up with some meaningful way to overcome those restrictions. And so that's what we need to think about. Now, if you do choose to do a cost segregation study and you are subject to passive losses, the deductions aren't, gone forever. They rather are just going to offset any gain that may occur if you were to ever sell the assets in the future. So that's what we're thinking. One thing we can think about is if you accelerate depreciation deductions and generate these passive losses that get limited in a specific year, we don't lose it forever, but the benefit just isn't really there because we can't use the loss from that real estate necessarily to offset the income from some other activity. And the reason we end up with losses in real estate activity is because of these depreciation rules that do apply. So we see what are referred to as paper losses. It might be a cash flowing asset, but because of these depreciation rules, they generate paper losses for tax purposes, which is why people love them, right? Like you can get a cash flowing asset without having to pay, a meaningful amount of tax on the asset. So the next thing to consider too, so the one problem with cost segregation studies, passive loss rules. The second is you may have to go through a process if you sell the asset of something called recapture. And recapture is really to say like, okay, you took these depreciation deductions in the past and now you're selling the asset. You might have sold the asset for more, that you basically created more gain than created more gain because you took deductions against that asset. And now the IRS is going to recapture them and tax them at ordinary income rates. So the benefits from a cost segregation study may be minimal or non-existent if you don't plan to keep the property for at least 5 to 7 years. This is because of that depreciation recapture rule. When you sell your property, again, you'll have to recapture the amount of depreciation you've previously taken on that personal property, and it's going to be taxed at ordinary income rates. And so this can be, if you've got other losses in a year, then that might not really matter at all. You can use a certain amount of activities to offset those gains, depending on whatever your overall strategy is. But it's something to be mindful of. And then lastly is if you're kind of a student or someone that utilizes like-kind exchanges, oftentimes what you'll see is people will avoid the recapture problem by doing a like-kind exchange, which is basically a tax deferral strategy. Basically, you sell one property and buy a new property within a short amount of time. And then basically for IRS purposes, if you do this like-kind exchange, a Section 1031 transaction, you can basically say, I didn't really sell the asset, I just exchanged the asset, right? Like I disposed of one and acquired another, and I couldn't really dispose of it. And so this like-kind exchanges only apply to real estate starting in 2018. And so it only applies even to real property. So when you do a cost segregation study, what we're doing is we're separating real property, the building and its components, from the personal property. And that personal property is what is generating our benefits, our accelerated depreciation. The rules of like-kind exchanges basically say that if you've got too much personal property, kind of associated with this transaction that might be otherwise eligible for a 1031, if too much of it to the value of the assets being sold is being, in relation to the total sales price, if you've got too much, you're disallowed from a like-kind exchange. So the IRS has issued detailed regulations on what constitutes real property for 1031 purposes, and they've adopted kind of a broad definition of what real property includes, including most items identified in a cost segregation study that are fixed to the building. But such a fixed personal property can be eligible for a like-kind exchange. But if the exchange involves movable personal property, think of if you were to take the building, flip it upside down, anything that would fall, that's kind of considered movable personal property. If you were to able to take the land, flip it upside down, what falls is movable personal property, such as furniture, and the fair market value of that is 15% or more, 15% or less of the aggregate value of the replacement property on the other side of the exchange, then the personal property is not going to trigger some sort of recapture. However, if you've got too much personal property and you're kind of exceeding that 15% threshold, it could trigger a recapture scenario where you didn't actually get that deferral like you would usually use a like-kind exchange for. Now, the IRS has what they refer to as an audit technique guide that details what cost segregations should look like from an IRS audited perspective that substantiates our separation of, real property versus personal property. So this is kind of where the most amount of guidance the IRS gives on this. It's not in the tax code itself, not in the Treasury regulations, but really just, how the IRS has trained its IRS auditors to go about conducting, IRS audits of these transactions. So there are two types of engineering-based cost segregation studies. One is a detailed engineering from actual records. So this is when an engineer is going to use cost information from construction and accounting records. They're going to examine each component of the property to determine its depreciable life and then allocate costs of one purchase price accordingly to, building and it's a fixed component, building and its components, and then the personal property. This is really the gold standard when it comes to the cost segregation studies, but they're also, for that reason, the most expensive. So they can be, $5,000 up to $20,000 or even more, depending on the type of asset, the magnitude of the transaction and the real estate being purchased. So then you can use a cost estimation approach, engineering cost estimation approach. This is a method similar to the actual records method, but it uses estimates, right? Just kind of like you would think it would. It is where the cost records are not available, and which is often the case for most used property that you're buying. So if you're not buying a new property, but buying a used, previously owned piece of real estate, you're not going to have all of the records. So you're going to have to use some estimates. So when it comes to, there are also some non-engineering based cost segregation studies, which are cheaper than the engineering based, but the IRS doesn't really consider them as reliable. There are approximately 4 types. Sometimes you'll see other ones, but first, you'll get a survey or letter approach. This type of study is, involves person executing the study, contacting contractors, subcontractors, those types of professionals to ask for specific information on the cost of the assets they installed on the project. So maybe you buy an asset, and you're going to go in and make some improvements, before putting it on the market for rent or that sort of thing. The survey letter is going to go ahead and reach out to contractors and subcontractors under this approach. And it's, usually you're going to use it for newly constructed property, but you can sometimes, like if you're doing, a purchase and doing some amount of flipping, you might be able to see some of that as well. The next is what we refer to as the residual estimation method. This is where the costs of 5, 7, and 15-year assets are added together and then subtracted from the total cost. So we basically say, here's the cost of the assets that we have purchased that are personal property in nature. And then they identify those costs, and then they say, here is the total purchase price, back out the land, back out the personal property and improvements. Here's the value of the building. So we determined the value of the building last as the residual, what's left. That's what residual means. You can do a sampling approach, which is where the cost segregation company is going to create a statistical model that builds out components and costs by analyzing multiple similar properties. Really, the property owner is going to go online, complete a questionnaire, and obtain a cost segregation study based on the sample and the proprietary algorithms that cost segregation study provider has determined for the building components. So these can be a few $100s and maybe the best choice for lower cost properties. And then sometimes you'll see a rule of thumb. So these studies are based on the preparer's experience and industry averages. They use basically no documentation, and the IRS is like very skeptical of them. But it isn't prohibited that those be used in, executing in utilizing them. They're not prohibited, but they're going to be skeptical, and you'll have a lot more back and forth with an IRS examiner if that were to ever come your way. So like I said, the engineering-based approaches are going to be the most reliable, but there's no requirement for any specific methodology. The most important thing is the substantiation of your depreciation deductions and property classification. When estimates are the only option, the methodology and source of any cost should be clearly documented. And deciding on the type of cost segregation study really depends on the value of the property. So if the expense, because of the cost of an engineering-based study is more prohibitive, usually you'll use an engineering-based study for properties that are like $750,000 plus in value, excluding the value of the land. So the building and its internal components being $750,000. But otherwise, you can use online cost segregation calculators to get an idea of what accelerated depreciation deductions you could anticipate, to kind of give you an idea of how you want to go about what you can expect for your cost segregation study. So when it comes to performing the cost segregation study, the time to do it. So once you've kind of considered, passive activity losses, the risk of depreciation recapture, and your prospect for a 1031 exchange, if you were to, plan to exchange an asset in the future, usually you'll do it in the same year that you buy, build, or remodel the real property. You ordinarily will spend the most amount of money on the real estate in the first year, so you'll get the most benefit if you do it in year one. But you don't have to do it in the first year. You can wait until a future year. But it does get more complicated from a tax return perspective, and your tax return might be more expensive in a future year. So that's kind of something to think about. When you do a study after the year that the property is placed in service, you'll have to complete what's called an accounting method change form, which is a form 3115. They're kind of complicated, and you really should not be doing them on your own. You really should be using a tax professional that has experience with accounting method changes. And you'll basically complete this, attach to the return, and claim an accelerated deduction for those assets that had been previously depreciated. So that's really kind of what you're thinking about, is because the cash flow is most likely going to be in year one. That's also when you're going to want to claim the study. Now, to be fair, if you know that year one you're going to have passive activity loss limitations and not benefit from it, you may wait until tax year 2 or 3, when maybe you might have a change in professional status, such that you could be eligible as a real estate professional status on the other side in a year or 2, and then you go ahead and do the cost segregation study. That might make sense. There could be a good reason for that, but yeah, most of the time most people don't have that amount of awareness to understand that that's going to be the case for them. So just keep in mind that you kind of want the deductions to go with the cash flow. And so that's what we're looking for by using year one. So 5 key takeaways from kind of this video. Residential rental properties, 27.5-year depreciation, and non-residential is 39. These assets are placed into service and depreciated as one lump sum unless you otherwise break them out. And that's where we use a cost segregation study. We segregate the costs of the residential rental, the real property that we're looking at, into personal property or land improvements contained in the property. The cost segregation study does not increase the value or the amount of the deductions. It only changes the timing of the deductions, so when you get to claim them. So because we've got the bonus depreciation deductions that are eligible, and particularly the 100% bonus depreciation deductions eligible in a post One Big Beautiful Bill era, there's huge benefits to be able to take deductions in year one versus later years. So that's kind of where we're seeing the big benefit right now, as opposed to previous years where bonus depreciation and Section 179 limits were lower. A cost segregation study of some kind needs to be conducted to identify which elements of a property that is purchased that are personal property and land improvements that are separate from the building itself. The IRS and the courts haven't determined any mandatory requirements for what must be contained in a cost segregation study, but there has been a detailed cost segregation audit guide provided by the IRS. So we need to, take that under consideration when we're looking at, evaluating a provider and understanding, what are their qualifications? What type of study are you buying? Is it the right time? Is it the benefit? All those sorts of things. So then we've also got some property owners are probably not going to benefit from a cost segregation study because of passive loss rules. Maybe they're going to sell it not in the too distant future and have some depreciation recapture, or it might preclude them from a like-kind exchange that would be planned in the future because we've identified too much personal property or land improvements that are otherwise ineligible from a like-kind exchange. It disqualifies the like-kind exchange and therefore all the benefits associated with it. And then lastly, the best time to perform your cost segregation study is usually the same year that you buy, build, or remodel your real property. This is because you want to match the deductions to the cash flow. That's when you get the most benefit. And so that's going to be the year and when you do the study to claim the fastest depreciation. So all of these things require some judgment and require, a consult on how to execute and all those sorts of things. And so if you'd be interested in, having a conversation on some real estate transaction that you're looking into, I'd recommend you book a call, use a link down below, and we'll be in touch soon. So I look forward to chatting with you soon, and thanks for watching, and we'll be in touch soon with another video. Take care.